Hi folks, welcome to this video on convertible debt that's convertible at the investor's option. In this question, we're going to do an example to show you how to calculate the relevant amounts for the bond and the conversion rights, and also show you how to make the entries at the issue date of the convertible bond, at an interest payment date, and as well when actual conversion occurs. So let's begin. In our problem, we have a company, Blue Cliff, that issued bonds on January 1, X1, when the market rate of interest was 6%. In order to get bonds that included a conversion privilege, the investor paid, or the company, Blue Cliff, received from its investors $10,760,000 for the bonds. The bonds were face value $10 million, coupon 4%, and they had a semi-annual payment, which means that interest would be paid every June 30th and December 31st because the bonds were issued January 1st. So we count 6 months from that date to get June 30th and 6 months from the June 30th date to get December 31st as our interest payment dates. Now we know that the bonds were convertible at the investor's option in 15 years' time. In our question, that was the maturity date. So now, with that in mind, we know that the common shares were convertible. The bonds were convertible, each $1,000 bond into 25 shares. So now, what this question asked us to do was, first of all, in requirement 1, decide what price the bonds would be issued at if they were not convertible. The reason why they asked you to do this is you'll recall that we use the incremental method to value the bond and the conversion rights. So under the incremental method, what do? We value the debt first. So all we're saying is that we gave the issuer Blue Cliff $10,760,000. Blue Cliff has to divide this amount up between the bond without the conversion rights and the conversion rights, because the money that was given to them from the investors, that $10,760,000, was what they paid to get a convertible bond that has the rights in it. So all we're doing is splitting it up into two pieces. What's the value of the bonds without the rights, and what's the value of the rights? Because when we add those two together, that's going to give us the value that the investors paid. So the first thing we should do to value the debt is let's find the present value of the bond without the option, right? So if we use our Texas Instrument BA2 Plus calculator, we've got 10 million plus or minus future value, 200,000, because again, just to explain this, again, we don't know if at the maturity date the investor will convert or not. We have to assume that they might. So we're going to calculate or include in our present value calculation the present value of that lump sum payment 15 years time from now, assuming that they might not convert because we don't know what they'll do. So we've got that factored in. We also know as Blue Cliff that we have to make a $200,000 payment in interest to investors every 6 months. And how did we get that? Well, we used the face value times the coupon rate times 1/2 because it's a semi-annual bond. And don't forget, all your rates are always quoted annually. But because our bond pays interest semi-annually, we multiply by 1/2. And when we do that math, we get 200,000. We know that our market rate of interest, they told us in the question, the market rate was 6%, so we're going to use this here. And we know the bond is 15-year bond, so we're going to make 30 interest payments. If we did a compute PV, we're going to have $8,039,956 as our value of the bond without the rights. That's just a pure bond. So now we know that the bond trades at a discount. How do we know? Because the present value of the bond is less than the face value. So we know it traded at a discount. So what would the unamortized discount be at the issue date? It would be the difference between the face value and the present value, which would give us $1,960,044. So now we've got the value of the bond given that assuming that the bonds were not convertible. Now the question asks us, how would we value the options? Well, again, we're going to use the incremental method, and we're going to squeeze out the value of the conversion rights as the difference between what we paid for the bond, including the rights, and what the value of the bond was itself, right? Without the rights. So how could we do that? Well, we could just look at it more visually and say, well, if we paid $10,760,000 to get a bond with rights, and we just calculated the value of the bonds without the rights, This must be, under the incremental method, the plug or the squeezed value for the conversion rights. The other way to look at it is say, well, if we paid $10,760,000 for the bond with the rights, and we know the bond without the rights is $8,039,956, then the value of the conversion rights must be $2,720,044. So bearing this in mind, what we have in requirement 2, what entry would we make to show a value for the bond without the rights and a value for the rights on the issuer's books? That's Blue Cliff. Well, Blue Cliff would make a journal entry that debits the cash, $10,760,000, because that's what it got from investors. It would also record a credit to bond payable of $10 million, and also record the unamortized discount of $1,960,044. And then we calculated, or we would include here, the contributed capital on the conversion rights, which is $2,720,044. Now notice we've called it contributed capital. That's any amount of money that the investors have given, right? It includes that. So the investors gave us $10,760,000, which includes this $8,039,956 for the bonds, which is the difference between the face value and the unamortized discount. And they also paid us for the conversion rights, which is $2,720,044. So it's considered to be contributed capital because it's a right that the issuers have at a later date that they paid up front for. So this account for the conversion rights, it's considered contributed capital, and it's also going to show up in the equity section of the balance sheet. So now let's go to requirement 4. Requirement 4 asked us to record the interest at June the 30th using the effective interest method. So what we're going to do here is we're going to use the opening carrying value for the period within which we're calculating our interest expense, which would be the date that we issued the bond. So in other words, January 1st X1 is the value to open up the period within which we're calculating our interest expense for, because June 30th X1 ends the first 6-month interest date, right? And this date is the date we're paying interest. So we're going to use the opening carrying value of the bond, which is our present value at $8,039,956, multiply it by the yield, because to find interest expense, we use the yield, and then multiply it by 1/2, because this is an annual rate. We want to get the semi-annual amount. And the interest expense would be $241,199. Because June 30th is an interest payment date, we're going to credit cash for the amount of our PMT, which is $200,000, and we're going to squeeze out this value, which credits the discount, to amortize it by $41,199. And you can notice that I plugged that. Now, in requirement 5 said, assume that the bond was converted at maturity, and 15 years from the issue date, which was January 1 X1, 15 years from that date would be December 31st X15. So we're going to assume that they got the interest payment on that date, which was owing to them, and now they decided that at the maturity date, after they got their interest, they're converting the bond. Now it says here that at the conversion date, the bond or the market value of the shares was $44 a share. So if you remember back to what we said earlier, we said it would make more sense if an investor converts the bonds into shares when the market price exceeds the conversion price. So we had all the data to calculate the conversion price, so I'm just using the data in the question. And we can see that for every $1,000 bond, we can get 25 shares. So the value of the shares inherent in the price of the bond is $40 a share. So these guys can get 25 shares for every $1,000 bond they have that are really, from their perspective, based on what they bought, worth $40 a share. But they could take those shares now and sell them on the open market and now make $44 a share, right? So they can make $4 a share. So the idea is only when, or more likely, when it's the case that the market price exceeds the conversion price, that's when an investor is more apt to convert. So that's why in this situation they told you that they converted the bond at maturity, and they also happen to tell you here what the market value of the shares were to make the situation for conversion more credible, right? So now, How do we calculate the value of the shares that we're going to be issuing, we being Blue Cliff on our books? Because what we're going to do is we're going to remove the bond, remove any unamortized discount, which at maturity is going to be 0. So we'll talk about that again in a moment, right? And then we're going to credit common shares. So what are we going to do? We use the book value method to convert the bonds and issue the shares. So the credit to common shares using the book value method is going to calculate the value of the bonds at the conversion date, which is their present value. But don't forget, at maturity of the bond, the unamortized discount is 0. So the value of the bond, including unamortized discount, is going to be 10 million less 0, which is 10 million. So we've got the value of the bond there and the value of the conversion rights at the date that we convert. And don't forget, there's been no conversion to date. It only takes place at maturity, so it's 2,720,044. So altogether, we're going to wind up crediting the common share account for $12,720,044. So now at maturity, what are we going to do? Well, the entry at the conversion date, which in our case the problem told us was maturity, is to debit the bond payable for $10 million. Notice we don't have any unamortized discount that we have to get rid of or credit because it's already all been amortized, right? So what we would have to do is we would have to remove the contributed capital on the conversion rights. Why? Because we didn't convert. Over that 15-year period, we didn't convert. So what we would do now is that we're converting. So prior to that, we had no conversion. We can only convert at maturity. So in this case, because we're converting at maturity, we're using up those rights. So we would debit the rights and we would credit the common shares for the value we calculated here using the book value method, which is $12,720,044. Now, let's assume here that in requirement 6, they tell us, let's assume that the investors decided at maturity not to convert their bonds into shares. That could be because maybe the market price of the shares was less than the $40 conversion price. We don't know the reason. But the question asked you to assume that the bond was repaid at maturity, meaning that the company retired the bond. The investors did not exercise the right to convert the bonds into shares. So now we need to record the repayment of the bond at maturity. So at maturity, if nobody converted their bonds into shares, then the issuer has to pay the investor back their cash, which is that lump sum payment. So we're going to debit the bond payable and credit cash for $10 million. Don't forget, at maturity, there's no unamortized discount to deal with, right? And we would assume here that the interest has already been paid at December 31st, X15. So they would be converting after they got their 6-month interest payment. So assuming the interest was already paid, we're going to debit the bond and credit cash. But because they never converted, we have to get rid of the conversion rights, right? So what would we do? Well, we have to get rid of the conversion rights at $2,720,044. But because the company paid up front for those rights, or the investor paid up front for those rights, and they decided not to use them for whatever reason, they decided not to exercise them, the company, Blue Cliff, doesn't give them back that money. Blue Cliff is saying, well, you paid for the right to convert. You decided not to. That's your business, right? So we're going to keep your money, but we reclassify it. So we don't keep it in a conversion rights account. We keep it in a different conversion rights account. We credit it to an expired or lapsed conversion rights account. And that shows up in the shareholders' equity section. But it shows the reader that this is the value of rights that the investors had at one time that they chose not to use. So they expired or they lapsed. Okay? So this concludes the first part of our video, which deals with the requirements in the question that we were given. Now, what we're going to do is in the second part of the video, we're going to add a new requirement. Our new requirement is going to look at the possibility that perhaps the investor did not wait till maturity. Let's say the bond contract was configured differently, and let's say that they exercised their option to convert part of the bonds into shares before maturity. So that's the second half of the question. So thanks for listening, and on to part 2.